I want to welcome John Carney to the podcast. He started his career as a takeover lawyer at Skadden Arps, the fabled law firm in New York. And then he showed a total lack of good judgment and became a journalist. He started at dealbreaker.com. He built financial coverage at Business Insider. He went to CNBC to create his own section online, net, and then to the Wall Street Journal, my beloved paper. And now John Carney is the economics and finance editor of Breitbart. Welcome, John Carney. You've been writing a lot about the Fed and where it's going with interest rates and how different that is from what the stock market is thinking. So why don't you tell us about it?
Sure. The Fed has made it pretty clear that they plan to keep raising rates, not just one time, but probably two more times this year. If you look at the official projections from the last meeting, they said, there's at least one more hike in there, and then they're planning on keeping that till the end of the year. The market right now is convinced that that won't happen. They're convinced that there's no more hikes, but maybe a 50-50 chance of one more hike, and then cuts all through the rest of the year. Basically, the market thinks we'll be 100 basis points lower than we are right now by the end of the year. And that's diametrically opposed to what the Fed said. The Fed said we're going up a little bit. And frankly, I'm even more hawkish than the Fed on this. I think the Fed's going to find that it has to go above where it thinks it needs to go and go where the more hawkish members of the Fed, like Bullard, thinks that they're going to have to go up to closer to 6%. So this idea that we're going to be closer to 4% by the end of the year is fantasy land, and Wall Street is totally bought in on it.
And yet, what about the wisdom of crowds? What is it that Wall Street professes to know about Fed policy that the Fed itself doesn't know? How do you figure this happens?
Yeah, well, so one, it's the wisdom of crowds can also become the imprudence of lemmings, right? They're all rushing in the same direction. I think there's a weird disconnect going on. People got more or less on the same page as the Federal Reserve up until about a month ago. Then when we started to have the problems with Silvergate Bank and then with Signature Bank and Silicon Valley Bank, people said, we're having a financial crisis. The Fed's got to cut. But you know what? If you look, the financial crisis didn't actually bother to happen. We had a couple banks fail. We had a beginning of a run on a couple other banks. The Fed stepped in and said, we have this facility, you can borrow at par. So that kind of stopped the run. The FDIC kind of hinted, maybe all deposits are backed. So that stopped the run. And if you look at the most recent data, the run has stopped. There isn't a flood. Yes, deposits are still coming out of the banking system as a whole, but this rush out of the small to medium banks is not happening right now. So I think Wall Street is priced in a financial crisis that isn't happening. And so therefore, they're going to end up having to take back this pricing where, the Fed's going to cut. I will add one other thing. If the Fed does cut, it won't be because of this phony financial crisis. It's going to be because the economy somehow falls off a cliff. I don't see that happening right away, but that should also be bad for stocks. The idea that this is bullish for stocks and for every other asset in the world seems a little crazy to me. That if the Fed cuts 100 basis points between now and the end of the year, that means the economy is doing really terribly. And frankly, I don't see it happening. It's just not in the numbers.
All right, John Carney of Breitbart. Let's add a little context to what you're saying in terms of the banking crisis and whether it's over and whether it was even truly a crisis versus just an isolated couple of banks got in trouble. Signature was a crypto lender. Of course, it got in trouble. Silicon Valley Bank was in that community where they kind of cut off all funding by the 60% plunge in the fourth quarter. But these emergency loans that banks have taken, they go to this Fed discount window. You've been writing about this. I read some of your stuff. And usually in a given week, guys, they have $10 billion in loans to the Fed discount window, right? And this is where they can take bonds that are underwater. Let's say they've got, $1 billion, $10 billion in bonds, but $1 billion underwater and it's only 9. They can borrow $10 billion based on those bonds, right? And then use it to fund deposits or whatever. And then John Carney reports that this borrowing, $10 billion a week, went to $110 billion in the '08 financial crisis, which was, we heard Jay Singh of Special Situations call it a 7 on a scale of 1 to 10 in severity. And now the borrowing since Silicon Valley Bank, and the week after that, it went up to $117 billion. You want to elaborate?
Yeah. So first of all, I just want to say those are all nominal dollars. So even though the borrowing is higher, if you adjust it for inflation, it's actually probably not higher. So, okay. What was back in 2008, 110 billion was probably nominally, or in real terms, higher than what we're seeing now. But what I will say is, the Fed made this especially attractive. As you said, they're offering, normally when you go to the discount window, you get a discount. Actually, you put up your securities for collateral to get money, and you get not 100% on the dollar. You don't get par value. The Fed changed that through two different facilities, through the discount window and through this new term bank funding facility. You now can hand in a bond that you could sell for 80 cents on the dollar right now. Partly just because the interest rate is so low on that bond, the coupon is low enough that nobody will pay 100. You could get a 4% bond instead of the 2% bond. So, but the Fed will take that at 100%. So that's very attractive. So, and I think a lot of banks actually took money as a precautionary thing. They want to make sure they're not going to have a problem funding any withdrawals. So they go to the Fed, they take a bunch of cash for this collateral. It's just a loan. And they borrow it for a year, and they have it not because the system is actually falling apart, but because they want to make sure that they have enough cash on hand if they need it.
Okay. Now let's talk more generally about the Fed's view of the economy. I mean, the fact is we can see some effects that inflation is slowing. We can see that, they're always talking about recession. They've been predicting it for over a year. And the Fed is hell-bent to make sure it does cause one. It seems like the fastest way to end inflation. Although, maybe if you put fewer dollars into the economy from the government spending and borrowing, it might help. What do you say? Yeah,
so I think that right now we've seen a slowdown in headline inflation in the year-over-year numbers. But I like to look at the median CPI, which is published by the Cleveland Federal Reserve. And what that tells you is the median CPI, which is it's just the middle of the lane of, so it gets rid of all of the outliers, all of the, if used cars go way up and then they fall way down, you just ignore that. You take exactly what is average inflation. And what this tells us is that inflation actually hasn't come down at all. We have had 0.4% month to month median CPI every month, September, October, November. We actually got 0.6 in January. And then it came back down.
Increasing 0.4% from the previous month you're talking about.
Exactly right. So
climbing. Okay.
That's a very important point, Dennis, because a lot of people, when I say it's 0.4% month over month, they don't realize that this is compounding, right? This is 0.4% on top of a 0.4% on top of a 0.4. So it's not that prices are stable. It's that the rate of increase is still going up at exactly the same rate. And that means that, in fact, inflation is running quite high, much higher than the 2% target that the Fed has. It's not coming down in terms of this gauge of underlying inflation. And so therefore, and frankly, the Fed doesn't talk about median inflation that much, but I know that they think about it. And I know that they're looking at that and saying, that's not good. We need that number to start coming down, or else we have a risk of inflation going back up.
Okay, so you have incredible data that you access. You get this Cleveland thing, and I read your stuff, okay, and you zoom up on that microcode in a great way. But now let me kind of zoom back out and point out that it seems hard to believe to me that inflation, which was quiet and quiescent for 20 or 30 years, suddenly, systemically, is going to stay there forever. We had all of these short-term effects. We had COVID. We had $7 trillion in stimulus. We had the Fed's balance sheet swelling up. And so this doesn't have to stay. This can end up fading with the Fed having done nothing. It's not going to stay. And I really think that overreacting, raising rates 21-fold, that's what they did, the actual borrowing rates, 21-fold in less than a year, will help send the economy into the recession that they want. And so I really think that the inflation thing is oversold, and there's too much fear out there, because don't things eventually return to the mean the way they've been for 30 years, John Carney?
Well, yes and no. Remember, we still don't quite understand the way inflation works. And this caught Fed officials by surprise. They thought we would have a very short term, transitory was their term, inflation. And because they did think it was mostly due to supply constraints, but it turned out that a huge part of it was juicing up demand through, which did come from fiscal stimulus. In particular, the Trump administration put a lot of fiscal stimulus in, and then the Biden administration, even though there were signs the recovery was coming, could not accept that Trump may have created the recovery. So they had to come in with their own plan.
Dramatic.
Right. Here's the American Rescue Plan, $2 trillion, $1.9 trillion. We're going to pump it into the economy. They had to do this because they ran on the idea that Trump had destroyed the economy. And so they couldn't come in and say, oh, we don't have to spend that much because it turns out everything's okay. So
it would be embarrassing. It would be embarrassing to do nothing.
Right, exactly. So they had to do something so that they could claim credit for the recovery, right? And because they had told everybody that the economy was in shambles. So they come in with this, giant plan, totally unnecessary. Their own guys, Larry Summers, Olivier Blanchard, are warning them, don't do this. Like, this is too much. If you want to do something, right, do a $500 billion spend, help the poorest people if you want to. Don't send checks out to everybody. Don't do $2 trillion of stimulus. This is not a good idea. Don't keep the student loans on hold. Don't keep the evictions on hold. Remember, it wasn't just the money they actually spent. It was money that stayed in people's bank accounts because you didn't have to pay your student loans. If you didn't want to, you didn't have to pay your rent. You can't get evicted. So this put a lot more money into the system, and that helped trigger the inflation. The problem is once inflation gets going, I'm not sure it's so easy to bring down because here's how the wage price inflation, if you don't mind, I'll explain how I think this works, and it's different how most people do. So a lot of people think, oh, well, what happens is workers demand more money and that pushes up prices, right? That's actually backwards. What happens, from what I can tell, is that workers see that their earning power gets eroded by inflation. So they get hit, groceries are up 12%, eggs are up 70%. And they say, all right, I got to get some more money, right? So they look for a better job. Their better job pays them a little more. Their old employer now has to hire somebody and pay them a little more to go into there. They now have more money to spend, and that helps push inflation even higher, right? So it's actually the opposite. It's not so much that workers anticipating inflation in the future demand more money now and therefore drive inflation. It's they're reacting to the inflation that has happened. So instead of expectations, which the Fed is obsessed with, I think it's experience of inflation drives up wages, which therefore drives up prices. And I think we're in that cycle now.
Okay, please let me take the other side of this trade. First of all, wage growth has been so stubborn, so stingy. Okay, and the fact that the thought that companies and employers, they're demanding higher wages, we're going to pay it. No, it's not proven anywhere. Number one. Number two, let's remember that inflation, really the definition, John Carney of Breitbart, and you know this well, is a massive increase in the supply of dollars chasing a much smaller increase in goods so that prices go up. Well, that's not happening at all if the government will stop spending. I want to note that $2 trillion extra by Biden, that was great stuff you just said. And no one in the media and no one in policymakers wanting to now investigate what's been going wrong is looking at that as a cause of inflation or the Fed policy itself. Now, there's something else that showed up in one of your stories, this idea that they worry that the supply-demand balance will push inflation higher. A supply-demand balance can't do anything to inflation because it's not increasing the amount of currency in circulation.
I think that's right. I don't think we could have gotten the inflation we have. I blame the Biden stimulus, but that couldn't have happened without the Fed accommodating it with a massive expansion of the money supply. And one of the things I've written about in another post is that the Breitbart Business Digest, we talk about money supply, which almost nobody talks about. But I had a recent Breitbart Business Digest that looked at the revisions to the money supply in March. And this is very important because we thought, based on the previous data, that last March, the money supply had peaked. So March 2022, we thought that was peak money supply, and money supply M2 had started to come down since then. What we in fact found was that money supply stayed high through March, April, May, June, and peaked in July.
So of 2022.
2022, money supply peaks in July. So what does this mean? This means that the money supply starts shrinking instead of March in July. That probably gives us another 5 or 6 months of high inflation. So if you were predicting that inflation would come down based on the shrinking of the money supply beginning in March, you now have to say, okay, maybe now it's not coming down until the second half of this year. And so I do agree with you that the money supply absolutely is the determinative factor here. And it's telling us inflation is going to be around for a little longer than we thought.
Okay. Another point would be that I believe the inflation statistics overstate the actual experience in our lives in several ways. Number one, they still haven't found a way to keep up with the fact that technology costs per unit fall 30, 40% per year. They don't know how to figure that out. I had an argument with Stephen Lippman at CNBC back when, and he told me I shouldn't be saying that. And number two, okay, so they say rent is skyrocketing. I have a lease. My rent hasn't gone up at all in 2 years, so I'm not affected by that. They say beef prices, my God, they're up, 40%. I can switch to chicken. I mean, all of the things we see in the headline are the things that the Fed are fighting and hurting the economy to do it. And yet those headlines don't truly reflect the inflation I might feel in my life. I don't think Americans' expectations of rising prices has changed their behavior in any way. I don't think they've had a binge buying because I got to buy now because the price is going up. I think we're taking it in stride, and a lot of people just don't even care and they don't feel it yet. If you're driving every day, you feel that from high gas prices. But guess what? We did 30 years of research in my Forbes days. High gas prices were anti-inflationary because you couldn't spend that money on jet skis. Go ahead.
Right. No, that's a great point about. So one, I'll just differ. I do think that some inflation hits people more than others. I think food inflation, even though you can substitute it to other things, does hit people a lot harder. When it comes to stuff like inflation in furniture, most of us aren't buying that much furniture at any given time. So yes, the price goes up, but we're not sitting there going, oh no, the price of tables is up 20%. We just won't buy a table right now. It's fine. But I do think food inflation hurts people. It hurts people, especially around holidays where people feel weird about substituting out of the prime thing, right, into
you don't give up the turkey, babe. You don't give up
exactly.
The turkey.
People want turkey. We're coming up on summer barbecue season soon. People are going to want the ribs. They're going to want, the good chicken. They're going to want the beef. They're going to want the steaks. So, I do think food inflation is a lot more salient. But I think your point about gasoline is really important. We just saw the Saudis make a large cut to oil production. And this is probably going to push up gasoline. There's always the question, and I take your side on this, of whether this is inflationary or not. In some ways, yes, it's inflationary because gasoline is part of inflation. So it pushes up the headline number, definitely.
But I think the database, right.
Absolutely, right. But I think the bigger effect is the one you just described, which is the money you're spending at the gas station is money that's coming out of other things. So I think it has a deflationary effect on prices of services and goods that aren't directly tied. Food might be different, by the way, because a lot of petroleum goes into fertilizer, and that's probably tied to the price of oil in a different way. But a lot of other prices, I think, actually come down because demand goes down because people are spending so much at the gas pump.
Right. Now, why don't you talk about the employment picture? Because you track that closely. And what people don't realize is they feel like, oh, once the Fed sees 2 quarters in a row of negative growth in GDP, that's a recession. No, the NBER, this National Bureau of Economic Research, it really looks far more at employment numbers, and it wants to see job reductions and job cuts through the economy. We see, 10,000 job cuts, 20,000 job cuts at Amazon, Google, without realizing that they had added actually 30 or 40,000 people in the previous 2 years. We see, Elon Musk cut, 75% of the 7,500 people at Twitter, and yet the platform is as robust and functioning as well as ever.
What were they doing?
The job number, yeah, what were they doing, man? And every tech company should be asking that same question about their incredibly woke, blue-haired employees who are sitting there, wanting a higher minimum wage or something. So what about the job numbers? What do you think that will allow the Fed to do or force the Fed to do?
So I think I agree with you about the two consecutive quarters of contraction not being a recession. I had a lot of arguments with people on the right last year who wanted to insist that we were in a recession. And my problem was look, when you have unemployment as low as it is, you could find, if you want, let's not argue about a definition of a recession. It just won't feel like a recession to people when you have unemployment below 3%. It's not that. And so until unemployment gets, frankly, I don't think it's a recession if unemployment, one definition some people use is if unemployment goes up by 50 basis points or 100 basis points, then you're in a recession. That's not a bad guideline. People will say that, but I still think if we're at 4.5%, for most of our lives, Dennis, 4.5% would not have been a recession. That would have been a jubilee. That was a bonanza. Right. That was a really good unemployment rate. So I do think that whether or not you want to say the NBER is the be all end all when it comes to recession, you can say that a recession really has to be a more generalized downturn. It can't just be technical factors that go into the calculation of GDP that show a contraction. You really want to see unemployment to really consider something a recession. You want to see unemployment go down. You want to see businesses pull back pretty heavily on investing. Those are the markers of a recession. That's what the NBER looks at.
Well, more than that, John Carney of Breitbart, I think you want to see people feeling utterly depressed about to the recession, and the spirit of these people right now in America simply isn't going that way at all. As much as especially the Democrats, I feel like they like to say that we're in crisis all the time. I think people had 2 years of pent-up demand for joy and for getting out there because of COVID. And they had higher savings than they had in years because of government giveaways. And I think that the Fed and a lot of policymakers aren't even realizing the possible impact of that in terms of, curbing their efforts to send the economy into recession.
I mean, look at what just came out recently in the JOLTS number, the quits number. 4 million people quit their job in February. That is a really high number historically. And when people are quitting their job, I know that a lot of people are like, doesn't that mean people are unhappy? No, people don't quit their job when they're fearful or unhappy. They actually quit their job when there's a better job, when they either already have a job lined up or they expect to get a better job very soon. So when you have a very high quits number, that is a sign of, robust worker confidence and
a robust economy. In fact, you had 4 million people quitting and you had 6.2 million people finding new jobs. Okay. In the most recent, this is a monthly report or weekly? It's a
monthly report. Yep.
Monthly. Okay. So you had 4 million people quitting in that recent month and 6.2 million finding new jobs. Do you have any idea when the 4 million people quit, what percentage are finding a new job within what time?
I mean, that almost, we can just look by the ongoing unemployment claims numbers. Now, quitting, you don't get unemployment, but that's just a good sample of how fast do people find jobs, right? And it looks like they're finding jobs almost immediately. And frankly, look, I have friends who are in the service industry who are, one of my friends runs a restaurant a couple, miles away from where I live. And he's always trying to find people. Right now, he can't find enough people. He sometimes has to have empty tables in his restaurant, which kills him because he doesn't have enough people to give the service he needs. So demand for workers is really high right now.
And what is it? We have 38% of able-bodied under age 65 Americans sitting at home on the sofa and not in the workforce at all. I mean, that's a problem with productivity. That's a problem. I mean, it means that the unemployment rate is actually vastly understated in a sense. Now, I imagine a large portion of that is maybe stay-at-home parents, let's say.
Sure.
I just wonder what it takes other than higher wages to get them off of the sofa.
I think a interesting thing happened during the pandemic when we told people to stay home. A lot of people probably stayed home and said, you know what, I like this. I'm okay. Right. Like this, I didn't like my job anyway. They didn't realize that they could do this. They did it. And now they're just going to keep doing it. I don't even think higher wages is really going to draw them back in. I think we may be at a long-term, at least, next 10 years, lower participation rate.
And that, John Carney of Breitbart, is a true sign of how strong the American economy really is. That 38% of able-bodied working age people can choose not to work. I got to tell you, man, that's pretty indolent. Our problems, when you look at that in the big picture, our problems are so small.
I think that's right. I mean, look, I do want an economy, and I know some conservatives hate this idea, but I want an economy where people who especially decide they want to be a stay-at-home parent, can do that. We do want an economy where you don't need everybody working. I mean, you want somebody working in each household. That's a good idea, but you don't really need everybody working. And you definitely don't want, entire neighborhoods of blighted unemployment. That's bad. But the idea that everybody who is able-bodied should be working, I think is, maybe serving corporate interests more than human interests.
John Carney, economics and finance editor of Breitbart. What a wonderful humanistic point for us to wrap this interview on. That's a dismount, baby. Fantastic job. Please promise, man, you're going to come back. All right.
Absolutely. Keep reading the Breitbart Business Digest. I like that you've got all that right in front of you, man.
That's really good stuff. Well, have a glorious day, John. Thanks a lot.
You too, Dennis.